Good morning, everyone. Welcome to the Foreign Correspondents Club of Japan, the people who are in the room and those who are joining us online. And welcome to the latest of what we call our deep dive events, in which we ask panels of experts to discuss topics of current interest. I'm Anthony Rowley, a former president of the club, and I'll be acting as moderator today. And the subject today is financial markets calm before the storm. And we have three eminent panelists to discuss the subject, and I'll introduce them very briefly, say a little bit more about them later. To my right is Paul Sheard, who's a noted Australian-American economist and Harvard scholar. Joining us online from Washington, D.C. is Hung Tran, who's a non-resident senior fellow with the Atlantic Council's Geoeconomic Center. And to my left is Jesper Koll, a well-known face, who's expert director for the Monex Group and the Japan Catalyst Fund. That's the order in which they'll be speaking. Okay, well, we'll get more or less straight into the discussion because we've got three panelists. But some of you may be wondering why we're focusing on the financial system at a time when obviously everybody's attention is riveted on Trump tariffs. Well, I mean, tariffs impact trade and economic growth, and that in turn affects the financial system and financial markets. But I think what we also want to look at today is whether there are hidden stresses or threats in the financial system, given the prospect of slowing economic growth, rising inflation, and high levels of debt. I think it's fair to say we're really living in interesting times at the moment. Stocks, in many places at least, are at record highs. Bond markets are jittery. Gold has been soaring, hitting new highs, and cryptocurrencies are grabbing the limelight. So what to make of all this? Well, our experts will address at least some of these questions, and then we'll have the opportunity of putting questions to them later. So, Paul, if you'd care to lead off, please. Thank you.
Thank you very much, Anthony, and it's always a great pleasure to be here and an honour at the storied Foreign Correspondents Club of Japan. So I'm, as an economist, always a bit reluctant to sort of answer the question, are financial markets, particularly the stock market, is it going up, is it going sideways, or is it going down? I kind of hand that thorny task over to my equity strategist or fixed income strategist colleagues. But so maybe I won't get into that too deeply, but let me sort of perhaps more skirt around the topic and talk about some of the forces at play that I think are more benign than might be suspected, and then one I'll end with, which I'm a little bit more worried about, more geopolitical framework. But first of all, so let's sort of mark to market, where are we in sort of the global economy? And, I, as an economist that's been around the tracks a few times, I'm kind of always surprised by there's always a new episode which is opening up, which is kind of not your normal situation. And so if you review the last 5 years, we've had just a roller coaster ride in the global economy. First, we had the COVID shock. That led to the biggest drop in GDP in recorded history. 8, 9, 10%, depending on the economy, even more. And then we had one of the fastest recoveries because the shock to GDP was quickly followed by massive fiscal and monetary stimulus. And of course, we're still living with the aftermath of that. Economies recovered very quickly, partly because COVID was an unusual shock. It was a very exogenous shock. It wasn't coming from within the system where you had, say, imbalances unwinding or whatever. So economies recovered very, very quickly. COVID had damaged the supply side of the economy. The demand recovery was just so strong that, guess what? We ended up with inflation. CPI in the US in particular going to 9% at one point. What happens next, of course, is central banks that had eased monetary policy dramatically during the COVID recession suddenly backed up. And so we have the Fed, for example, going from essentially zero interest rates up to 5.25% to 5.5% to essentially restrain demand and kill that inflation. Well, inflation has come down. It's still a little bit above 2% in the US, but largely that dragon has been slayed, and so now central banks are cutting interest rates. We're back into this interest easing cycle. But the Fed is on pause at the moment. It's cut by 100 basis points because inflation is still stubbornly a couple of percentage points, 2 or 3 or 4 percentage points above the Fed's target. And of course, the Fed is looking at the Trump tariffs and the uncertainty working its way through the system and saying just a little bit too early to keep cutting interest rates, say like the ECB, which is down to 2%. So that's kind of the broad sort of where we are and how we got here. Looking at the outlook, if you look at the IMF forecasts, I guess, as respectable a forecasting house as anybody, GDP was 3.5%, global GDP 3.5% last year. The IMF thinks it'll come in more like 2.5% this year, and looking for 3% next year. So a kind of a slowing global economy this year, as some of those kind of monetary tightening forces work their way through the system, as there are other uncertainties coming in. Again, maybe you point to Trump there. But then a bit of a recovery into next year. But 3% global growth is not particularly stellar. It's, we should be looking at something more like 4% perhaps than 3%. Now, what about sort of the things that Anthony worries about? And I have to say, Anthony's a bit more of a worrywart than I am. But he still gets me up here to talk about these things, so I'm grateful for that. But and Hung's in Washington, D.C., and he may have much more to say about some of these issues. But if you look, the reference would be the global financial stability report that the IMF puts out. The latest one is in April of this year. And they flagged 3 risks. One was sort of, very rich valuations. Now, I didn't mention the equity market. The S&P 500, of course, is roared ahead, is up about 90% relative to the pre-COVID peak. So in COVID, of course, the stock market fell about 24%. That's more than a correction. But then again, it bounced back and roared ahead. And I think, again, that's what people like Anthony and others worry about. And if you look at the valuations, they're pretty rich, PE ratios and other valuations. But I'm going to come back to that. So, the IMF pointed out in its most recent report that the stretched valuations are a vulnerability in the system. So you wouldn't be surprised if, with a shock or two from here and now, that equity markets in particular corrected 10, 15, maybe even 20%. The thing that makes me a little more sanguine about these things is if you look at long-term history of the equity market, it is stocks for the long term, as Jeremy Siegel, the Penn professor, pointed out many, many years ago in a classic textbook. The stock market is essentially a call or a claim on the residual profits in the economy, and economies tend to keep growing, particularly the US economy. And so if you're sitting there as the residual claimant on an ever-expanding economy, you tend to do quite well, and the S&P and the stock market sort of picks that up. So every time the stock market corrects, it tends to recover and then go up further. If you go back and look at the global financial crisis now, let alone if you went back to, say, the 1987 sort of Greenspan crash that's in all the famous, not that Greenspan caused it, he kind of responded to it. But that's also part of the picture, that when you get these corrections in stock markets or you get crises, that's when policymakers, the fire brigades arrive, and there's a lot of stimulus that offsets the shock. But if you look at the global financial crisis, I won't call it the Lehman shock, as you do in Japan, for obvious reasons. I'll call it the global financial crisis. Inside joke. You hardly see it, in the GDP numbers or the S&P 500 now. So, a longer-term perspective would suggest, things are pretty good. But let me then say, because I think probably the time is ticking faster than I thought, let me sort of touch on 3 kind of areas, if you like. As I said, 2 that I'm a little bit more sanguine about, 1 that I'm a little bit more kind of pessimistic about. So the first one is talking to this, the stock market in particular in the US. And, I like to look at who's driving the stock market. What are the top stocks in the stock market? Many of you may know this, but in the US, it's, NVIDIA is the biggest one now. market cap is north of $4 trillion. I can remember it wasn't too long ago where when the first stock broke $4 trillion, it was news. Now, 9 of the top 10 stocks in the S&P 500 have market cap above $1 trillion. So again, is that something to worry about? Or is that just the stock market doing its job of discounting the future flow of profits that it sees out there into the future? But you've got NVIDIA, then Apple, so I think it's Apple or Microsoft, the order changes, Amazon, Alphabet, that is Google, you've got number 6 is Meta, Facebook, etc. I'd never heard of NVIDIA until a couple of years ago. So here it is now, the biggest stock in the world, I guess, north of $4 trillion. But if you look at the top 10 stocks there, what you're looking at is digital stocks, the virtual economy, the tech sector, Silicon Valley, the winner taking all in this digital revolution, this digital transformation, this AI transformation that we're now living through. And it's a cliche to talk in those terms, but it is actually happening, and it's being reflected in the stock market. And so when I look at the valuation, so NVIDIA, it's up about 55% in the last year, I think or 50% or so. Its P ratio is about 55. You say, well, this is overhyped. Is this, Now I'm not going to, I don't want to talk about individual stocks in terms of investment recommendations, but you can make that story that it's surely it's going to run into some trouble. Well, I was saying the same thing about Facebook when it went public in May 2012. It IPO'd at about, I think, $36 a share. It finished the week down, and I'm thinking, yeah, of course, we didn't really call them social media companies in those days, but this college kind of, social media connecting system, surely that doesn't deserve this kind of valuation. Well, it's now north of $2 trillion, I think, market cap, or at least definitely well north of $1 trillion. Stock price is something like $770 or something. So, don't listen to me for investment advice, I guess, is the point I'm making. But so that's sort of one area, if you like, of the innovation. We are living in this age of Schumpeterian creative destruction. The stock market is always trying to look to the future and figure out who are going to be the winners, who is going to capture a share of this economy, and that's how you get these digital companies dominating the S&P 500. It's interesting, by the way, just given that we're in Japan, to contrast that with the top stocks in the topics, for example. No prizes for guessing who's number 1, Toyota. Number 2 is Sony. I think number 3 is Mitsubishi UFJ. Number 4 is Hitachi. Number 5 is Sumitomo UFJ, et cetera, et cetera. And you look at that list of stocks, and it's a very kind of established not old economy or traditional conventional economy. There are no real sort of IT, let alone sort of AI kind of companies in that top 10. Maybe Recruit. It's like Recruit Holdings, maybe the one service sector orientated. Maybe they're into IT these days. So there's a kind of a contrast there between the two. You mentioned crypto. Again, I'm not a crypto fan, Anthony. I'm kind of, again, as a traditional kind of economist, rather in the more of a conventional view on these cryptocurrencies. But you look at Bitcoin, when I wrote my book, The Power of Money, the peak had been about $69,000 on Bitcoin, and it was down to about $20,000. And I pointed out that, these cryptocurrencies and Bitcoin in particular, they're not really currencies. They do have a store of value aspect to them, but they're essentially a risky speculative asset. But there's a story behind it that you hear all the time from the crypto people, which is the supply is fixed. 21 Bitcoins, that's all that's ever going to be mined. And a story about ever-increasing demand, which pushes the price up and up and up. People hold it on a sort of a speculative demand basis. It's now, I think the price is $118,000 or something. So again, I kind of joke that I might be right, but you might be the billionaire holding Bitcoin. So again, in that area, I'm skeptical. I don't think that that space is going to overturn the sovereign monetary system, which I'll get to in a moment. By the same token, it does seem that cryptocurrencies, stablecoins now, and particularly with the backing of regulatory authorities, the Trump administration, I got the tip about the Trump administration's friendly approach to cryptocurrencies when I was having a haircut in Melbourne, and my Lebanese barber gave me the tip, and he heard it from his son 6 months earlier. So, it feels a bit like bubbly, and and maybe it is a bubble, but I don't think even if that bubble unwinds, it's going to damage. It's not going to cause a global crisis that we've seen in say, 2008 kind of territory. Let me talk about the second point, which sort of people worry about, which I'm nowhere near as worried about, which is sort of the sovereign debt, the government debt. And of course, people focus particularly on the US and the federal debt that's building up, the budget deficits, etc. Now, why am I? Well, first of all, the facts here. You'll hear in the US in particular, now the number is now $36 trillion. That's the size of federal debt. Now, it's a $30 trillion economy in the US and growing all the time. But, people quote GDP, debt to GDP ratios, and they quote them in percentage terms. So the debt to GDP ratio in the US is over 100% now. But a couple of kind of caveats here. One is that, analysts should always be careful about their units of analysis. And percent is not the right unit of analysis. It's a stock divided by a flow per period of time. So dollars over dollars divided by time, which is a year, say GDP in a year. So the correct unit of analysis, I'm getting a little bit wonkish here, but is number of years equivalent of GDP. So if the debt to GDP ratio is 100%, what it means is that the stock of government debt is the equivalent of 1 year's flow of GDP. It's kind of apples and oranges, frankly speaking. But it's sort of better than that because the number you should be focusing on really is debt held by the public, because some of the debt's held within the government. Same thing in Japan. Now, there's a quirky thing in US statistics where in that number they include holdings by the Federal Reserve. So if you net out the holdings held by the Federal Reserve, you're down to about $24 trillion, which is at roughly about 10 months equivalent of GDP. But you might say, well, gee, if we have to repay that, that's still an issue, isn't it, Paul? And a big part of my book, the first part of my book is explaining, and I'm not the first person to do this by any means, but explaining that government debt is not something that has to be repaid. It no more has to be repaid than if you happen to carry banknotes anymore, the banknotes in your wallet have to be repaid. It's a liability of the central government. Federal Reserve is part of the federal government. So basically, government debt, in its true underlying nature, is akin to, it's a digital form of banknotes, in a sense, which is created by the government. It's money. It's injected into the economy. But it's not something that has to be repaid. Now, it looks like it has to be repaid because governments can print money at will, and if they do that, and there's no checks and balances, we're going to get inflation. So society figured out we better put some shackles on this, and part of the shackles is to get governments to issue bonds, and now it looks like they're actually having to repay those bonds at a certain repayment schedule, and they might not. So it looks like this mountain of debt getting bigger and bigger and bigger is just a bigger and bigger mountain of debt that in the future will have to be repaid. And if it's the future, that means it's our grandchildren that somehow will have to repay this stuff, which they won't. They'll inherit the federal debt as an asset. Everybody will inherit it as a liability, and kind of the two kind of cancel out. There are certainly distributional consequences, particularly within generations. But a lot of the way we think about debt is misguided and therefore leads us, I think, to worry about, like, oh, a sovereign debt crisis is looming. It's coming in Japan. It's coming, Japan is like Greece. No, Japan is not like Greece. Greece is part of the euro area and doesn't have its own printing press. It cannot create euros at will the way that the Bank of Japan or the federal government here, the central government here can. So that's sort of the background to why I'm not really too worried about the federal debt that's building up in terms of, it's something that we're just delaying the day of reckoning. No, what is the day of reckoning? The day of reckoning is if you print too much money, if you run too sustained budget deficits, you'll continually creating purchasing power, which is being transferred into the future, particularly via the bond holdings, the government debt. That's a transfer mechanism of purchasing power into the future. And the more and more of this stuff you have, the risk is that at some point this purchasing power gets released into an economy that can't absorb it fast enough without creating inflation. And so it's sort of a tussle in many ways between the first factor I talked about, which is this technological innovation and this continuous process in society that we're getting more and more productive, more and more able to produce more goods with the same inputs, or more inputs, more outputs with the same inputs. So either way you look at it, we're able to produce more, and it's a race between the two things. But if the government, so to speak, loses the race, in that at some point, take Japan, for example, massive amount of government debt owned by households. If Mr. and Mrs. Tanaka woke up tomorrow morning and felt really rosy about the world, or maybe pessimistic because they want to spend their money, you could get inflation going through the roof in Japan. It's not happening because that has never happened. That change in psychology has never happened, but it could happen. Well, what would happen then? The Bank of Japan would raise interest rates. Interest rates might go back to 5, 6, 7%. And the government may have to raise taxes, not to pay for the aging society and social welfare, but to remove purchasing power from the economy to cool down inflation. So that's the way I'd look at government debt, rather than through this insolvency trap is just around the corner kind of argument. How am I going for time? Ooh, I think I'm over.
You're okay for 5 minutes.
Okay, 5 minutes. So that takes me to my last point, where I will get a little bit more more kind of pessimistic. So the big risk that I see in the global economy, and this may be a risk that takes years to play out, is not so much, it's not the financial markets, but it may end up there, but rather is the geopolitical situation. And, I've talked about this, I've written about this recently. A couple of weeks ago, I had an interview in the Japanese Shukan Economisto, where I talked about this. So let me just quickly parade the idea. Again, big picture, zooming out, we're living in this truly kind of remarkable geopolitical time. It's been building up for a while now, with the rise of China in particular, and the relative decline of the share of GDP of the US. The US, obviously, very vibrant economy, but the share has come down. Essentially, the post-war era of Pax Americana has come to an end, and it needs to be replaced by something. What does that Pax Americana mean? Really, there are two elements. One is the idea that the US is essentially the policeman to the world. US spends as much on federal defense as the next 9 countries combined. It's 3.7% of its GDP, and its GDP is pretty much the biggest in the world on a nominal basis, certainly. Nominal basis, the US is about 27% of global GDP, China's 17%. When you do the more technical calculation of PPP, purchasing power parity, they flip. The US is now 15% and China is 20%. But most of these numbers are cited in nominal terms, and there the US is dominant. So the US is the sort of global policeman kind of idea. And then the second element of sort of this post-war era of Pax Americana and prosperity was the US underwriting the global international order. Free-ish trade, the WTO system, free capital flows, etc., through the whole Bretton Woods system, particularly post-early 1970s. Now, why did the US do that? Well, these are sort of sometimes described as global public goods. And the reason that, in a sense, that the US was willing and able to play that role was that it was big enough to internalize the externalities. And therefore they were able to supply the public goods. It wasn't just pure altruism. It was, to a certain extent, self-interest, but self-interest because the US was so big. Now, what happens? Trump comes along, and of course, I don't usually focus on Trump the individual. I focus on Trump the phenomenon, because Trump arose out of the American polity, and out of the American polity, out of what is now called the MAGA brigade or people, was this idea of, why is the US fighting forever wars? Why is the US got bases in 80 countries. Why is the US spending so much on defense when our water systems are not working, when our education system is, I get on the New York subway almost every day when I'm in New York. Oh my God, I just think mentally, I wish I was in Tokyo. It's the infrastructure is creaking. So guns and butter. And so Trump comes along now, and he's elected because he gave voice to those people, which was very much an anti-elite, anti-establishment kind of voice. And he comes in and he doesn't think of things in these ways. What he sees is, we're being ripped off. So what to me would be a system whereby the US was supplying these public goods, partly out of its own self-interest, but partly maybe, benevolent as well. Let's give some credit. He says, they're ripping us off. That's why we've got a trade deficit. Our market's open, their market's not open. NATO is not spending enough on defense. Japan is not spending enough on defense. Let's go to 5% of GDP in NATO. Let's go at least to 2% in Japan. So guns and butter, but more guns, which means less butter. And so what's happened here is that Donald Trump in particular has kind of upset this global order, and it's heading in a dangerous situation, because with increased military spending, you don't just get less resources for domestic prosperity, but you get rising geopolitical tensions and ultimately wars. And here we have a war in Ukraine. Well, you can't blame that one on Donald Trump. It happened under the Biden administration, but he said he'd put an end to it on day one. 6 months now, and it's getting actually, if anything, worse. You have obviously problems in the Middle East, and this kind of this uneasy sense that we're just putting China on the back burner for the moment, but we'll get to China. That's we've got 3.5 years left. We'll get to China and the Taiwan problem. So I'm quite concerned about the remilitarization in the world, not good for economies, and the risk that does trigger major global conflict, because you essentially have Russia is a nuclear superpower facing off against NATO, and that war potentially escalating at some point into something much worse than it already is, and it's bad enough to begin with. And of course, the second issue is what's happening in trade. Now, we had a panel here in April, and I argued with Hung Tran and then Richard Katz, who's on the call. We had a little debate about this. I was more in the camp that I think Trump's using this as leverage, all these reciprocal tariff off-the-chart numbers, and over 3 to 6 months, give it to 3 to 6 months, hopefully he'd bludgeon other countries into submission, hopefully in his mind, and hopefully in the sense that he'd then be able to reduce the tariffs and would come back to some not too high tariff level. The tariff issue would subside. We're kind of in the middle of that process at the moment, but again, it is a very bloody-minded process where the US seems to be using its kind of incumbent power. It's the fact that it was the center of Pax Americana. It is the most powerful military and economic power in the world, and it's sort of going one by one and sort of bludgeoning its trading partners into submission. And what's happening in the meantime is the whole sort of most favored nation principle that underpinned the GATT and the WTO. Most favored nation means that if I give certain tariffs, set tariffs for one country at a low level, I have to give that to all countries. Now, there are exceptions to that, trade blocks and things like that, but that's the guiding principle, and that is obviously being challenged dramatically. And we shouldn't lose sight of one fact. So if you look at who's done the trade deals so far, Japan, the UK, but then you've got countries like Indonesia, Vietnam, and the Philippines, and President Trump is railing against countries like that and saying they're ripping us off. I'll just remind you that the per capita GDP in those three countries, and we're talking about hundreds of millions of people, by the way. Vietnam's 100 million people. Indonesia's 250 million people. Philippines, what is it? Something like that, 80 million people. Per capita GDP is about, in nominal terms, about 5%, 5 to 6% of the US level. So you have a massively wealthy country, like beating up on these quite poor countries. In PPP terms, it gets up to about 15 or 16%, but it's still a very, very big gap. So there seems to be, we're in this moment where the global world order is kind of broken down and is in disequilibrium, let's put it this way, because the US will not be able to behave like this forever, because guess what? China, Russia, the global south, India, etc., will say, maybe we need to distance ourselves. Maybe we shouldn't be so much locked into the U.S. economy. So I see that as a kind of it's a vaguer, bigger global risk that's out there. Now, what's the alternative to that, Anthony? Is an alternative which nobody seems to be really articulating at the moment, which is to say, well, if Pax Americana is broken down, we need to replace it with a different order, one where maybe there is more regional and global security architecture. There's more focus on, perhaps we can spend less on defense if we can put diplomacy front and center. And on the trade front, I think, Donald Trump does have a point. If if the US has reached the point where they say, we want to have reciprocal tariffs, let's make them all reciprocal low tariffs, not reciprocal high tariffs. That would be the direction of travel that I'd like to see. But last point, this increased military spending and even wars, if they don't involve the major advanced economies, can still be quite good for the economy and for the financial markets. I mean, the federal defense spending in the US, forget about the number that's announced, on a GDP basis is $1.1 trillion. And of course, that keeps going up, and that's cumulative, that's a flow. So over 10 years, north of whatever it is, $10 trillion, enormous amounts of money. And of course, that has a strong multiplier effect. To come back to topic one, artificial intelligence, Silicon Valley, there's an increasing kind of fusion of high tech into defense spending, creating a kind of the Japanese talk about the kikan sangyo of the automobile industry being the kikan sangyo, the core industry that then has multiplier effects. U.S. defense industry may be behaving a little bit like that as well. So that's difficult to kind of tackle. And it's not necessarily that bad for the economy when you look at the numbers, but I think it is bad whether it's military spending or whether it's tariffs. Because what is bad about tariffs is it's a tax. And when you have taxes, you have what is called dead weight losses, loss of potential gains from trade. And they're the two things that potentially weigh on economic growth longer term. Sorry, I took a little bit longer than I would think I was given. Beg your indulgence as the chairman, but thank you very much, Anthony.
Thank you very much, Paul. Comprehensive overview, but of course, huge problems. I should have mentioned, of course, that Paul is the author of the Wall Street Journal best-selling book, The Power of Money. Okay, we'll turn now to Hung Tran, who is, as I said, a non-resident senior fellow with the Atlantic Council's Geoeconomic Centre. He has experience across the private sector, international organizations and research institutions, and he's a former senior official at the IMF and with the Institute of International Finance. So, Hung, over to you, please.
Well, thank you very much, Anthony, and hello to my fellow panelists. I would like to respond to your key questions about the disconnect between the uncertainty, unreliability, chaos in economic policy making of the U.S. tariffs, fiscal deficit, and so on and so forth, with the performance of the global economy and basically the stock market, equity markets, and financial markets. Why the disconnect, and will there be a crisis when the disconnect is being corrected? So 4 points. One is that when we look at the global economy and why it is kind of resilient so far, it is slowing down, but gradually and much less than feared at the beginning of the year. We have to keep 2 points in mind. One, Paul mentioned it, and I share his view, is that the high-tech part is becoming more important for the economy in the US. The Magnificent Seven really drive the performance of the stock market, and they add value and productivity growth to the American economy, become the leader or the driver of the economic performance in the US. But the similar story can be said about China. China, in my view, has been successful in re-engineering and changing the driver of its economic growth from dependence on property sector, accounting for more than 25% of GDP 4 years ago. Now, with the correction, that share is now down to 14% or so. And the gap has been filled by the so-called high-tech activity in China, green technology, electric vehicle, EV, batteries, solar, wind energy, and so on. So those three sectors are now making up for most of the gap created by the shrinking of the property sector. So growth in China is also begins to be driven more and more by high-tech production and manufacturing, and then with the overcapacity problem it creates, more to export, but then we can get back to that point later. So what I try to say is the high-tech activity has been quite resilient on the tariff story, which is really on own economy stuff like automobiles and so on and so forth. So that's one point. But the second point is also very important, is that the services, which have become a big part of the economy of own advanced economy, and even in China, services sector is now exceeding 50% of its contribution to GDP, has been quite strong. In fact, if you look at the global economy in the first half of this year, it's about 2.9%, which is less than the 3%, but most of that growth has been driven by growth in services and also contributing to sustaining the growth of global trade. Everyone a few months ago feared that global trade will decline because of the tariffs imposed by the US. But in fact, in the first half of this year, global trade increased by about 2%, driven again by the 9% growth in services, import and export year over year compared with the same half year a year ago. So I think that the services part will be the key factor going forward to help global economy deal with the tariffs on goods, and more the high-tech part will give some driver to this economy. So that's explained why it has been rather resilient. It will slow in the future, which I will come back to my third point, but that is for the future. But that is how we should understand why the global economy seems to be rather resilient in the face of tariffs war and high deficit in the US. That's one point. Number two is more about the so-called exuberance in the stock market. Again, you have to keep in mind that for the US stock market, look at the S&P 500. Basically, all of the growth that we have seen so far this year and even before is driven again by the 10% of the market, the Magnificent Seven, the tech stock. If you take that out, most of the remainder of the index have been suffering losses in share prices, not gains. So the exuberance is very limited. And if you account for that, then the breadth of the correction in the future will also be limited as well. But if you look at the S&P 500 overall and look at the price-earning ratio, it is richly valued, but not excessive. At the moment, it is about 17, 18 times price-earning ratio, which is a bit above the long-term average of about 14, 15 times over time. So it is quite richly valued, but nowhere near the extreme that it got into, like in the year 2045 times, or before the great financial crisis that Paul mentioned, almost 3-digit time in terms of price-earning ratio. If you compare that with Europe, the Euro Stoxx 600 price-earning ratio is around 14 times. So basically, the story that I look at is that, yes, the stock market may be a bit complacent when looking at the series of bad things that could happen in the second half of this year, when the tariffs impact will be passing through into higher prices. They haven't done so because companies have so far absorbed most of the increase in tariff in their own profit margins, but they cannot afford to do that forever. So at some point they will have to pass through, and the pass-through is beginning to show up in final prices. And the impact of higher deficit driving up bond yields will become into play as well. So we are looking for a disappointing second half compared to the resilient first half. And I think that stock markets have not, in my view, taking fully that into consideration. But for going forward, if that realization is coming through, I think that will lead to a correction, but more in the category of normal fluctuation of markets, but not in the category of crisis like we saw in the Black Monday or in the great financial crisis more than a decade ago. Number three, I completely share Paul's worry on the big picture, and I want to add something to that. Basically, my worry is that the geopolitical competition and conflict so far, and particularly with the Trump administration driving the process, has produced and really exacerbate the geoeconomic fragmentation of the global economy. So far, we have clear sign of fragmentation in trade flows to different camps, in investment flow with investment control, export control, import control. And I think eventually it will seep into the sphere of monetary arrangement as well. A lot of questions have been raised about the global role of the dollar, the acceptance of the dollar that have been underpinning the global economy so far, and that can be a topic for another deep dive. But basically going forward, I see a slow, gradual erosion of the dominant role of the dollar, which will be with us for some time, but at the margin, it will be weakened and eroded over time. If you look at the share of the dollar in global reserves, it has clearly, since the post-war year, is one of a downward movement from 80% in the post-war year down to 71% in 1999 and all the way down to 57.7% in the first quarter of this year, driven by diversification of assets, reserve assets by central banks, not in favor of any one currency to replace the dollar, but to a whole host of smaller currency and in particularly gold. ECB has analyzed it and showed that gold is now the second largest position in global reserves at 20%, ahead of the euro at 16%. So basically, my worry is that this geopolitically driven fragmentation of the global economy in different facets of economic and financial activities will be really hurting the potential growth rate of the global economy because it is a very inefficient and costly way of doing things. So that is a worry, not that we will have a global financial crisis anytime soon, but over time, the potential growth rate will trend downward, and that will bring to the fore all the conflicts and demand for public resources to meet unmet demands for infrastructure in advanced economies, for human needs and resources, and so on and so forth. So that is my big worry. And last but not least is a smaller, more specific thing that I focus on. I do not fear a stock market collapse or crisis, but I think that the next crisis will be triggered by the activity of the hedge funds engaging in basis trades, buying cash treasuries and shorting treasury futures. The volume keeps increasing. Now the hedge fund are borrowing at the repo market to the tune of $2.8 trillion, which is huge. And when US Treasury bond prices decline unexpectedly because of the concern about deficit, for example, is one of the possible triggers that will lead them to liquidate their long position in cash treasury to meet the demand and therefore reignite and cause spillover and fire sale impact on the market. So I think that is something to watch for. It was behind most of the market turmoil since in the past few years, particularly in the year 2000 after the COVID. And it is something that I think should receive more attention than performance of the stock market. So I will stop here and happy to engage in discussion with you on these topics and others. Thank you.
Thank you very much, Hung. Your final point was particularly interesting. I think we'll return to debt levels and the banking system in question time. So let's turn to our third speaker, who is on my left here, of course, Jesper Koll, who's recognized as one of the leading Japan strategists and economists, having worked as chief strategist and head of research for the US investment banks JP Morgan and Merrill Lynch. He's currently serves, as I said before, as expert director for the Monex Group and the Japan Catalyst Fund. Jesper.
Great. I mean, and first of all, a huge kudos to the previous speakers. I think you laid out, the scene very, very clearly. I want to sort of add just a couple of points, from sort of a practicing investor's perspective here. And the first one is that, yes, people are scared. There is no question, and you can see this in the asset allocation. Survey after survey shows it's not just Warren Buffett who holds record amounts of cash, almost $1 trillion, never heard of before. But survey after survey shows that whether it's in Japan, whether it's in Europe, whether it's the sovereign wealth funds, whether it's a pension fund, record allocation to cash. So everybody is scared, is worried. There's an enormous amount of uncertainty. Where does this uncertainty come from? What are some of the factors, and where does Japan come into this? I mean, the uncertainty comes from, look, inflation is very real. And you can argue about if you take out fresh fruit and if you take out energy and if you use a different type of seasonal adjustment, you can get it below 3%. But the reality is that the people are hurting, that you are hard-pressed to find a middle class anywhere in the advanced industrialized world where real wages, real incomes are actually growing. In fact, I did the calculation just for fun. In the last 2 years, if you were a Japanese pensioner, your purchasing power dropped by about 35%. So that's why the LDP lost the election. But that's besides the point. Inflation is real, so you're worried about that. And it's very clear that there is no central banker, whether it's in Japan, whether it's in China, whether it's in the United States, who actually wants to increase the cost of money, wants to actually destroy demand so that inflation comes under control. And there's lots of other factors going on as well, which add to the uncertainty. Second one after inflation, AI. Because here we have a technology that is going to replace Paul and me. No, it's very interesting, right? This is not robots who impact the industrial sector, the manufacturing sector. This is, something that replaces people who go to graduate school. Employment for software engineers in the United States is collapsing. And you've got, for the first time ever, university graduates, starting salaries are now below the starting salaries of a plumber or a high school graduates. I mean, people were worried a couple of years ago about the rise in youth unemployment in the People's Republic of China. Well, I'm sorry. Look at the United States of America. That's exactly what is happening right now. And of course, AI technology impacting directly the service sector, or what some people call bullshit jobs. Oops, sorry. No, but it's, David Gerber. So you've got uncertainty because we don't know how fast the disruption to the employment side that AI technology is going to come through. A third huge factor of uncertainty is that war has now become normal. The tragedy in the Ukraine, what is going on in the Middle East, it's quite remarkable that you had this strike on Tehran, and it was faster than a video game. So this conflict is solved now? Mm-hmm. It's quite amazing. But again, from a money allocator's perspective, right, the risk of war, right, is obviously there. And Paul is right. Obviously, I can invest in defense contractors. There is a play in the stock market on that. But in terms of overall geopolitical risk, the reality of war being, in place and the potential for escalation being there, right? And what's very scary, actually, the most scariest thing that happened this year for financial markets, was actually what happened between India and Pakistan, right? Because that was the first time that we could see showcase application of Chinese military technology. And you don't have to be an expert on this, but you realize that, oh my God, their stuff actually works, which is very interesting, right? So you've got inflation, AI, war, and then, of course, what my previous colleagues, talked about very eloquently, the reality of the United States of America, which was the anchor of the global governance system. I mean, America was always boss, but it was always clear, whether it was the Plaza Accord, whether it was Bretton Woods, the big changes that came to the global financial system, they were deliberated and debated for at least a year in advance before any action was actually taken. That obviously is not the case because Mr. Trump is king and everything gets decided on a whim in the White House. So the changes in global governance, right, with the United States acting, right, on its own terms, without deliberations, with its allies or with the existing multilateral framework, that obviously creates a huge amount of uncertainty. As an aside, I was a little bit involved in these trade negotiations, and it's very interesting. The Japanese government was quite right. It's like the biggest obstacle for them was, what guarantees do we have that this is the trade agreement, that this is a covenant that actually can be trusted, rather than, and I'm going to be facetious, next week Mr. Trump, eats a bad piece of sushi and gets angry at Japan and raises the levels of tariffs again. I'm being a little bit facetious, but this ad hocism, rather than a proper governance, right, is one of the big uncertainties that we've had. And thank you, we've got some trade deals here, but how reliable, how credible, how consistent will they actually be is obviously and remains, unfortunately, a very, very big question mark. A final point I want to make as a financial market practitioner, which creates an enormous amount of uncertainty. The baby boom generation is now dying. It's not just Ozzy Osbourne, may he rest in peace. But, you've got the equivalent of half of global GDP, right, being transferred over the next decade, because the generation post-war that created the wealth in the G7 world is actually now retiring. And so for financial systems, this transfer of wealth creates a huge opportunity, because I want you, when you pass away, not just to pay your inheritance taxes, but I want you to transfer the money to me as a manager. Right? So it's quite interesting that you've got that shift, and that's where, new technologies like crypto, like blockchain, actually become very, very important, and that's where this deregulation bill that the United States are pushing in financial services also creates a huge amount of opportunities, and obviously, as those assets shift, they also create risk. We'll talk about that in a second when we talk about Japan here. And then last but not least, and this is really, and I hate to be so blunt, the threat to the anchor and the credibility of the United States because of the weaponization of the SWIFT settlement system that happened with Russia creates a huge amount of uncertainty. And, of course, just a couple of months ago in the big, beautiful, what was it called?
Big Beautiful Bill.
The Bill Clinton. The big, beautiful bill, as you know, did contain in its original draft a thing called Section 899, where basically you were going to have revenge taxes. So if you and I, as a non-American, own U.S. assets, we could potentially be subject to a tax. Now, Scott Bessent, the U.S. Treasury Secretary, wisely took this or negotiated this out of the bill. But again, for me as Nippon Life, for me as a global investor, it was always over the last 50 years that America will treat capital best, no matter where it comes from. And it's not just the trade, where now we have to pay an entrance fee, a tariff, right, to participate in the US economy. If I, as an asset allocator, have to pay an entrance fee to participate in the US security market, right, which was a threat, but it was taken out. But, once the threat is out, so this de-dollarization risk, because America charging entrance fees, right, for participation in the capital market, is something that's not going to go away. Right? So these are the risks, that you actually have there. Now, the good news is that we know that President Trump has one boss, and that boss is not the Supreme Court. That boss is, not, Jerry Powell. but that boss is the US market, right? And I think it's very clear, if you're an optimist in all this high risk, high uncertainty environment where the threat to US asset markets is quite significant from a global investor's perspective, right? The reality of the moment you get triple yasu, it's a beautiful term, right? The moment you've got interest rates going up, i.e. bonds falling, you've got stock markets falling and the dollar falling, that moment President Trump became easier, right, on his original tariff threats. So in the asset management business, as a speculator, as an investor, the one good news is that Mr. Trump is beholden to US capital markets, that higher interest rates, a lower dollar, and falling stock prices, are the one thing that he appears to be listening to and that calls him to reason. So it's quite interesting. You have this. Now, let's talk a little bit for 30 seconds about Japan. And I think that here the good news is that the corporate metabolism has completely woken up. And it doesn't matter whether it is industrial companies, whether it is service companies, whether it is large companies, or whether it is small companies. You've got a record amount of corporate activity. Most obviously, you've got a record amount of M&A activity, right? Mergers and acquisitions. You've got a market for corporate control that is now up for grabs, right? And it's not just the Japanese activists, right, it's not just the global activist investors who are making plays, but you've got, for example, Mr. Nagamori, right, at Nidec, right, making a play for Makino Milling, which in the end didn't work out. But again, this is something that would have been almost unthinkable, 3 or 4 years ago. Now the domestic metabolism for corporate control, for industrial reorganization is very, very real. And in my personal opinion, this is actually being accelerated by the reality that you cannot rely, you cannot trust on the American market in the way that you used to do, because now the American market demands an entrance fee, right? Whether it's tariffs or whether it's other obligations that are going to be put for you. So just to bring back the point, the increase in the corporate metabolism, the reality that you've got corporate leaders now taking action to streamline their businesses, to invest in their businesses with record amount of capital investment expenditure, this onshoring that is happening here in Japan, actually gets accelerated by the reality of global economic uncertainty. I can tell you, I had a meeting, with the board of one of the leading car companies, right? And well, what should we do with Mr. Trump? And I said, look, the key thing is that the probability of America in a new regime, right? If after the midterms or if after the next election, who knows, right? The Democrats come back to power, the probability of America coming back to being a champion of free trade in the way that we grew up with over the last 30 years, that probability, I think, is close to nil. And so as a result of that, your global production map, you need to realign, very, very clearly here. One final point on Japan, which goes to the deregulation of the financial system and which goes to the risk to the financial system, which is that I talked about the transfer of wealth, right? Here in Japan, over the next decade, you've got actually the equivalent of 1.6 times GDP being transferred because of the baby boom generation retiring. Not retiring, excuse me, but because of the baby boom generation actually dying. What is interesting is that we are actually beginning to see deposit shifts. As you know very well, it's not just Norinchukin that is seeing deposits being liquidated because the farmers are dying out and the sons and daughters inheriting the cash are not reinvesting the money with Norinchukin because they're not farmers, right? They're reinvesting the money, thank you very much, with neobanks like SBI or other banks that are actually offering already 0.3 or 0.4% interest on a demand deposit. So it's very interesting that you've got the shifts in the financial system here in Japan, right, deposit shifts out of the regional banks, out of the secondary banking system, right, into, some of the other banks. And, there's a worry in global finance that the reason Governor Ueda is not normalizing interest rates at an appropriate phase is exactly because if you were to increase interest rates faster, those deposit shifts would be accelerating even further because the secondary banking system has neither the proper systems, technology, nor the proper staff to actually manage a world where demand deposits or interest rates are actually positive. So that's a big concern that you actually have, specifically here in Japan, that you're not quite allowed to talk about, but that is a concern. The primary banking system, the Mizuho, the Sumitomo Bank, and Mitsubishi Bank, Japan Post Bank, Resona Bank, they're perfectly well capitalized. They've got perfectly fine, systems and people, to actually manage a world where money has a price. But the secondary banking system here has a big question mark under itself. And if that turns out to be the reason for why the Bank of Japan is not normalizing interest rates, right? That's something that one should be a little bit concerned about. Thank you.
Fascinating, thank you. Secondary banking crisis, I've heard that term before. Just before we turn to question time, can we just elaborate a little bit on the banking system? Hung, you mentioned certain risks facing the banking systems in general. I mean, it's argued that banks are withdrawing from lending because of regulation. Non-banks, hedge funds, whatever, are moving into that space. So, taken overall, the banking and the non-banking systems, do you see I don't use the word crisis again, but threats arising there in the short to medium term. So, Hung, can you say just a little bit briefly again about the point you were making in the final parts of your presentation? Hung? Hello? Are you there?
Yeah, okay. Sorry, I unmuted myself. My point was really based on the recent report a few days ago by the Financial Stability Board of the G20. Basically, identify one of the risks that it concerns about is the non-transparent and growing linkages between bank and non-banks in a variety of activities. One is the activity of hedge fund, which I said borrowing $2.5 trillion from the repo market. Their counterparts are the banks and the broker dealers. And if the hedge funds are coming into difficulties, having to force sell their assets, suffering losses, that will be quickly transmitted to the banks via the repo relationship with the hedge funds. That's one relationship. Second is between banks and non-banks in financing real estate market, and particularly commercial real estate in the US and elsewhere. Real estate have received more and more financing from non-bank players, but eventually it is clear that many of those non-bank players fund themselves by borrowing from banks. So banks remain deeply involved in all kinds of real estate activities, particularly commercial real estate, but the linkage is not transparent. And therefore, if there is a shock in the commercial real estate market, price declines, many of the non-bank investors in those markets suffering losses, that again will be transmitted to banks as well. So those are the new linkages which have not been properly reported, and a lot of information collected about those connections, and that needs to be monitored more closely. But in the face of that, at the moment, banks both in the US and elsewhere are profitable. They are strong in capitals, way above the Basel III minimal requirements, and therefore they have been playing a fairly stabilizing role over the past few episodes of market turmoil, including one in 2023 with the Silicon Valley banks. So the banks, particularly the large one, are well capitalized, profitable, and in a fairly strong position. Nevertheless, the linkages to non-bank activities vis-a-vis hedge fund, vis-a-vis non-bank lenders directly to borrowers or to the real estate market are areas that need to be brought more with increase their transparency. So that is the issue that we need to look at the moment.
Okay, thank you. Paul, do you want to say anything briefly on that or not?
No, I think, again, this was a risk that one of the three major risks that the IMF flagged in their Global Financial Stability Report in April. And they've got a nice chart in their report showing how the funding has gone up and the proportion of Tier 1 bank capital that might be at risk and so on and so forth. But again, to underscore what Hung said, I mean, in theory, in principle, there shouldn't be a big risk here because, of course, we have the whole regulatory response to the Dodd-Frank, through Dodd-Frank, etc., to the global financial crisis. Regulators all over bank capital, etc. But again, I don't think you can regulate these financial risks out of existence. When you have a liquidity or you have a liquidity risk transmits into a solvency risk, becomes kind of self-fulfilling. Suddenly these connectivities and these linkages appear and get hypercharged that in normal times, don't rise to the surface. So, I think one of the points about financial crises is no matter how much you regulate them, you can't actually eliminate the risk of a financial crisis because there is a fundamental mismatch between the fact that the financial system is exposed on the asset side to fundamentally illiquid assets, and on the right-hand side of the balance sheet is fundamentally trying to transform those claims into liquid assets. But that's a theoretical point, which just says you should never be too complacent about these things.
But this is very interesting, and this I come back to this frictionless banking, and that's where crypting and peer-to-peer lending and peer-to-peer transactions actually become in, right? Because if you look at the last interesting shock that we had was Silicon Valley Bank, right? And Silicon Valley Bank, arguably was sparked by a tweet, right, from somebody very influential, who basically urged, his companies, to stop banking and to withdraw from Silicon Valley Bank. And, given that you can do this now, at least in the United States, I mean, I can transfer, $10 million, right, literally within 3 minutes. While in the old days, it would take 3 days, for this to settle. And so I think, as you do get the Genius Act and peer-to-peer financial activity accelerating, the risk of some form of herding, right, happening literally within half an hour and putting a financial institution, at risk, that risk, I think, is a risk that's going to start to develop.
Okay, do we have any questions from the floor first? Anyone care to raise a question? Or are questions online? Richard, maybe you or Kashiwagi-san, I see your name there. If you have a question, please don't hesitate to raise your hand. No? No questions? Yes. I think you raised your hand first. Please go to the microphone, give your name and ask your question.
Nicholas Denninger from Japan Industrial Partners. Thank you very much for this really interesting discussion. Highly enjoyed it. One risk, obviously, particularly from a Japanese perspective, but also really across the developed world that came up is the public debt issue, and running the printing press, of course, leads to the risk of future inflation. Could you elaborate on that perhaps a little bit more? I've thought about that point many times, and also in the past, and I wonder what it would do to the credibility of capital markets, of FDI into a country that would start running the printing press. If you had any further thoughts on that, I would be really curious to hear them.
Okay, Paul, maybe you should take that first.
Right. Well, of course, Nicholas, thanks for that question. But we've just been through, of course, a historical episode where we saw that exactly happen, and we saw the consequence, which was this burst of inflation. Then we saw how the institutions react to that, and particularly the institution of an independent central bank. So that sort of whole template, in a way, has been stress tested. One of the points that and again, it's sort of chapter 2 in my book here, is that give another little plug. But one of the points that when we talk about when we're talking about government debt deficits, or when we have that discussion, for example, about the trade deficit, there is a presumption often in the way that policymakers and general observers talk, as if these things are independent variables that are subject to direct policy control. So everybody would think that, well, surely the government sets and controls the size of its deficit. Well, you could look at it that way, but you could just as easily say that all of the actors in the economy, the global economy for that matter, that are deciding on their relative savings and investment decisions in aggregate are determining the budget deficit. Likewise for the trade deficit. A little bit abstract, I'm sorry, but the point is that the economies are complex systems where the different sectors, household sector, corporate sector, government sector, and then for a country, the external sector, are all kind of making decentralized decisions that have to add up to a certain consistency. So again, when you look at the recent blowout in budget deficits after COVID, you could say, well, the governments had to put their foot on the fiscal accelerator and pump a lot of money into the economy. That was true, but you could also easily describe it in terms of suddenly with the shock to the economy, investment went down and savings went up, and there was a huge surplus savings in the private sector that had to be absorbed by somebody. And because it happened as a global shock, it couldn't be the rest of the world, because everybody was looking to the rest of the world to absorb their surplus savings. So what happened? The only sort of release valve was a blowout in budget deficit. So again, from that perspective, it really, you have to look at what's causing these deficits to go up and down. But let me just finish on again another Trumpian point. What I focus on most in that sort of equation is, do we have the strong institutions that will take the necessary action when, for example, when and if that purchasing power burst into the economy? That's where you need the independent central bank. And one of the following the Trump administration, as I'm sure Richard in New York could testify, or anybody here, is like drinking from a fire hose. There is so much going on. It's hard to keep track of all of these different things. But of course, we have this interesting issue around the Fed and who's going to replace Jay Powell, and will he get sacked next week, and all this sort of stuff. And that's very much a question about, and we have also, potentially, if he was sacked, that would go into the legal system, would go up to the Supreme Court, and you could get some interesting decisions that either did or did not undergirth this institution of independent central banking. But in that sense, independent central banking and the ability of the central bank to take away the punch bowl or to tighten monetary conditions when inflation is picking up because there's too much spending in the economy, because there's too much money in the economy. That could be a really important kind of determinant of sort of what sort of future we live in. So I'm much more focused on the strength of the institutions than the size of the numbers and the ratios to GDP, etc.
Anthony, I would like to say something about the debt issue.
Go ahead.
Yes, I think that on the public debt issue, I share one point that Paul raised, but have other concerns, and that is advanced countries issuing debt in their own currency. They don't need to repay the debt because they can always deal with that by different fiscal and monetary means, including printing money. But basically, they are constrained. Because if they choose to deal with it by inflation, then inflation will rise, will lead to higher interest rate, will depress economic activity, and the economy will suffer, including household and corporate and everybody. So there's a cost of dealing with that by printing money causing inflation. If they don't do that, then they have to reduce spending in other things to make room for the debt servicing spending, which has begun to increase everywhere because of higher interest rate and higher quantum of borrowing in the past few years. So you spend more of your budget for debt servicing, including interest payment and principal payment. That means you have less resources for the rest of the needs of society, again, including infrastructure, defense, social services, human services, social welfare, and so on and so forth. And the more you pinch on all the needs, the stronger and the more bitter the fight for public resources, making domestic politics more unstable and more adversarial. So I think that there's a true cost of compiling and increasing debt too much. And last but not least, if the pace of increase in debt and the rate of interest, both of which are higher than the normal rate of growth of the economy, then that will become unsustainable the way economists talk about it, because overall the economy cannot just produce goods and services every year with enough resources to repay and to service the debt. So I think that the debt problem is a true concern. It may or may not happen in a blowout in a crisis, but over time it will really again sap the strength of the economy and weaken economic performance overall over time.
Jesper, you have a point.
Very quickly. There's a savings glut, right? Even in Japan, for every 1 yen of public debt, the corporate and household sector has produced about 1.8 yen of savings, right? So to Paul's point here. Now, there's a real world constraint which does matter, which comes back to the point about interest expense. If you and I are a politician, we're running the country, and now 1/4 of our budget goes to just service debt, right? We obviously have less money to spend on all sorts of other things. And our fiscal, authorities, the Treasury, is going to be very, very keen to actually tighten, taxes, to tighten Social Security contributions, possibly to even raise taxes, right? And that's exactly the situation that you're in Japan right now, right? It all worked very well because interest rates were basically zero. I mean, it's awesome, right? You more or less doubled your amount of debt, but your interest expense halved, right? Because interest rates went close to zero. Now that game's over. And, as a result of that, even the bonds that are maturing, because he's obviously right, technically, the government, you can stay in debt forever, right? But you do have to refinance. A bond that I issued with a 0 coupon or a 0.1 coupon 10 years ago, I now have to issue with a 1.3 coupon, right? All of that starts to accumulate. And for the people, right, this is a problem because the risk of further tax increases, of additional increases in other contributions, right? Limiting the ability of fiscal policy to actually direct and create incentives for growth. That ability is actually starting to be curtailed, right?
Does that answer your question?
Yeah, very well. Thank you very much.
Good. Okay.
That's why you do end up with the yen going to 200.
Okay, any more questions from the floor? Yes, I'm sorry, please.
Takuya Nishimura, freelance journalist. Thank you very much. As I saw the evening news last night about the Keidan Rain seminar, some business leaders had a concern about the 15% tariff, even if it is declined from 25% to 15%. They have certain concern about their futures, about their business. Do you think that that kind of basic negative impact of Trump tariff, even if it is 10% or 15%, the stock market or markets takes into account that negative impact in their activities? This is one first question of me. And second question is, the biggest uncertainty in United States is actually Trump. But the biggest uncertainty here in Japan is Ishiba, or the fate of Ishiba administration. How do you think that the replacement of Ishiba can affect the stock market? Thank you very much.
Okay, so we have two questions there. Perhaps Jesper first, quickly, if you would, on that.
So it's very interesting, right? Because there's obviously a cost for the tariff, right? And there is a short-term reaction that particularly for the car industry, the effective threat was 32%, which is what most analysts and the market had predicted, incorporated into their forecasts. And so if you go from 32 to 15%, that seems like, oh my God, it's better, right? Now, it's still going to hurt. It's still going to reduce aggregate profits for listed companies by somewhere between 5 and 8%, right? So corporate earnings in aggregate are likely to be negative by around 10% for the current financial year, and that's a factor. One thing, right, on the tariffs, which is very interesting. And first of all, if you're a Keidanren CEO, you're supposed to complain about the tariffs. That is your job, right? But the reality of the tariffs, particularly for the car industry, right, is that Trump, this is going to sound too harsh, but I'm going to say it anyways in these terms. Trump is doing the Japanese companies a favor, because he is the biggest structural challenge for Japanese car industry in particular is the People's Republic of China, because made in China cars are extremely well engineered, right, are well designed, and cost, be my guest, 30-40% cheaper, right? Trump is keeping Chinese cars out of the American markets. So to pay 15% tariff for my exports actually buys me a lot of time, right? From that perspective, so there's this irony about the whole thing. And if you ask me, the biggest risk would be that over the next 4 or 6 months, Trump actually makes a deal with China. And if you get BYD, as an example, to be allowed to build 4 factories in the United States of America, that's when Japanese car companies will have real problems. Okay. We can talk about Ishiba in a second, but let the others talk about the tariff.
Well, okay, but you asked about the impact on the stock market, and of course Ishiba is factored into that so briefly.
Ishiba is irrelevant.
Are you addressing me, or is that your answer?
Not addressing the microphone, right? But I mean, it's very interesting, right? I mean, there is no strongman politician in Japan. Ever since the end of Abenomics, right? We've had something called new capitalism, which I think you and I need to drink a lot of sake, to sort of find out what that actually may or may not mean. And, it's reasonably clear that Mr. Ishiba, has no economic policy that is of any relevance whatsoever. It gets interesting, to your point, if the LDP, succumbs and, elects a populist, Takaichi-san, right, who is outspoken about, as a first action, calling in Bank of Japan Governor Ueda and demand the reintroduction of massive quantitative easing, that would be very consequential. Outside of Takaichi-san, right, all the other candidates, the bureaucrats run the show. Takaichi is the one that would get the yen to 200.
Interesting. Okay, we have a question online, but Paul, do you want to quickly say something on the previous question?
Well, just very briefly, just a couple of points. First is, and I think I mentioned this last time we were here in April, let's say we do get 10, 15%, whatever it is, tariffs across the board. The US has raised its tariff rate. One would expect from sort of economic theory and economic evidence that a good chunk of that, maybe half, maybe more, will be absorbed by a stronger dollar, which would be a weaker yen. So the exchange rate will move to adjust to a certain extent to offset the effect of the higher cost of the tariffs on domestic consumers. But there's always going to be some dead weight loss, which is what really economists worry about. Second thing, just with this package that was announced yesterday, of course, I guess I did what everybody else did and scrambled to kind of read it. And of course, you can't read it because it doesn't exist yet. There's a fact sheet on the White House briefing room, but there are actually no facts. But what I did sort of giggle at a little bit, and I'm sure Jesper and Richard did, and Anthony, the old timers among us, all of us, $550 billion, this fund. And what is this fund? This is like government guarantees from government financial institutions. And it's sort of right out of the playbook of the old, big packages that were announced every time you needed a big fiscal package. So, maybe one of the reasons the stock market is taking this in its stride is that, who's coming to the rescue here? The Japanese government and taxpayer with a whole lot of credit guarantees. And, what played out is sort of pretty much what I was expecting, and I was kind of more or less saying perhaps Japan should do, is try to cut a deal, get a big announcement, say that you're going to build some factories in the US, get the tariffs down, maybe not down far enough at 15%, and then Donald Trump will move on to the next of the 150 countries on the list or whatever. And Japan, again, has a playbook about how to do this from the 1980s and 1990s, so it's kind of playing out in that sense according to what one might have hoped and expected.
Okay. Richard Katz, we have a question from online. Richard, can you go ahead?
Yes, hi. So I'm a little perplexed, and I'm hoping you can give me some wisdom here. It seems to me the global financial markets are saying, oh, thank you, Mr. Trump. You had said you were going to cut off both of my legs, and you only cut off one. I'm so happy. Walking with one leg is kind of hard. I don't understand why the markets are happy, commentators are happy. I understand why Ishiba says he's happy, but is this just a delayed reaction, or is there a disconnect here, or am I just too stupid to realize what's going on?
Very good question. Question I should have asked myself. Okay, Paul, quickly.
Well, I like your analogy, Richard. It's better than mine. I've been talking about someone who's banging their head against the wall, and then when they stop, they say, "Gee, that feels good." But I'll take your leg analogy. I don't know. I mean, it's very difficult to sort of second guess financial markets. They're kind of like, it's the amalgam of everything. So everyone's got a view and they put it into the mix there. But maybe part of it is also that relief rally. Maybe it's also that 550 billion, as I mentioned. Maybe it's also, I don't think to get back to what we were talking about in April, 15% may not be the end here. And, it's a double-edged sword, this fact that you can't really depend on these trade deals holding. There's also the potential they hold in a better direction, which is a little bit down the track. When the dust settles, again, Donald Trump has a good bit of sushi and gets up one day and says, "Oh, I just met the new prime minister and we're going to cut it to zero." And maybe the markets are factoring a little bit of that as well.
Okay.
Yeah, my answer to Richard would be to look at the individual shares of companies and to see how their share prices have reacted to the whole tariff development since the beginning of this year. As I said before, most of the growth in the S&P 500 index has been driven by the Magnificent Seven, which really have not been a relevant kind of companies when it comes to tariffs. So they are not being impacted by tariffs. Whereas the manufacturing company GM, take one example, has demonstrated that they have suffered from tariff. They have to reduce their profit margin to incorporate and not pass through the increase in prices for steel, aluminum, spare parts, automobile parts that have been subject to tariff. So those companies that have been impacted by tariffs have seen proper reaction by the stock market in terms of share price under pressure. So I think that overall, yes, one can say that there seems to be a disconnect between the so-called exuberant stock market. But if you look at company by company, then it seems to be a fairly rational process going on here. And companies that are subject to tariff treatment will probably continue to suffer more, whereas companies like the high-tech companies will probably continue to do pretty okay the way they have.
Okay. Jesper, do you want to say something briefly on that?
Look, I mean, like I said before, I mean, in the stock market is primarily about the car companies there, and you know, the reality. I mean, the reality is it's not quite the right analogy. I mean, I love the analogy of one leg versus two legs, but I mean, you know, Toyota will keep on driving, and the reality is that, you know, that a deal has been made. You know, that ultimately the stubbornness of the Japanese bureaucrats, right, which wanted to have a pure exception, Japan is different, you know, that they were able to come to the table and have an agreement that is playful. And this is interesting. Again, you and I hate this sort of governance. But if you look at the Trumpian governance with these one sheets of paper, and I love the way that you call it fact sheets, or they call it fact sheet with no facts, right? But there is a playfulness, you know, and an open-endedness to the whole thing. The reality that, you know, that a deal could have, that a deal was actually made, just spells a significant amount of relief. And then to the second point is, again, everybody's cashed up. The scary thing in global finance is that everybody worries about all these things that we talked about over the last hour and a half. The reality is that, you know, in the world of money, right, there is so much ammunition that is sitting there, and then you're going to get something that is called the pain trade. Because if you and I are a fund manager, we are in competition, and I am outperforming you because the stock market is going up, right? I have a problem. I need to deploy the money before the end of the year. So there is this bubble-esque, you know, this bubble-esque risk is now actually very, very high, you know, as these deals are being made and as the veneer of new covenants, right, is actually being accepted by the global economy, or certainly by the global money markets.
Yeah. Very briefly, if I may just follow up on that, inflows into the market, by which I mean the stock market, from pension funds, life insurance companies are huge nowadays. I don't have the figures before me, but are they so large now that the market in effect cannot fall, that the inflows from the institutional investors are so great and they need to compete with each other that the market simply cannot go down? Is that nonsense or not? Paul?
Well, I think it's probably nonsense if you say the market can never go down. But, you know, there is a linkage between, you know, we've been talking about government debt and money, and we've been talking about the stock market, that if there is a lot of money being created into the system, which basically comes from governments printing money and commercial banks printing money through their loan books, and, you know, that cash is either going to be sitting in the system earning, in the past it's been zero or close to zero, and now it's a little bit better. As there's more money in the system, asset price equilibrium requires essentially that the price of risk assets be sufficiently unattractive that people are quite happy to hold all that cash. And the way that risk asset prices become unattractive in relative terms is for the prices to go up. So there is this sense in the way the economy works that as money comes into the system, it creates a kind of a valuation bid for risk assets in the equity market.
Okay, Hung, do you want to briefly comment on that?
Yes, I think that that is not really sensible, because basically prices for stocks and for anything else is determined at the margin, not by the stock or the average of the holding of the assets. So you don't need the pension fund to sell, liquidate the whole portfolio that they have in order to move price. You just need one person wanting to sell, but there's no other person wanting to buy. Just the last person will cause the price to drop until that level will find a buyer for the one who wants to sell. So I think that at the margin, price will move. And the way the market is trading now with super high, super quick, algo-driven electric trading, I think that what Jesper said before, the potential for quick reaction, quick correction is very high.
Okay, thank you.
And again, at the margin, not at average.
Look, right, Anthony, I mean, every 9 months, on average, you know, the US stock market falls by at least 12%. within 24 hours. So, it'd be very strange if that were to stop. And certainly demand and supply alone, is not going to be the factor. The thing to watch out for, I actually think, is not the equity market. The thing to watch out for is global debt markets. And I think that, a continued steepening of curves, which is to say, the difference between short-term interest rates and long-term interest rates, to wit, I think I would be happy to place a very big bet, that, even if Mr. Powell were to succumb to, President Trump and start cutting short-term interest rates, my bet would be that long-term interest rates in the United States will not come down, that in fact long-term interest rates will continue to go up, precisely because, in my opinion, global underlying inflation, is a much, much more severe and sticky problem. I think watch the bond yield. And that's where Japan is very interesting, right? Because, obviously the interesting thing is that the Japanese yield curve, continues to steepen out. Right? Whether it's a 10-year bond, whether it's a 20-year bond, whether it's a 30-year bond, that's where the market is not stupid and basically saying, I'm sorry, we see exactly what the Japanese people feel, which is that inflation is a problem that's not going to go away. And by the way, the more capital investment expenditure you do here in Japan, the more new factories and logistics hubs and hotels you're going to build, the more severe your resource constraint is going to be. And it's very interesting. We talk about politics, right? It's very interesting. So the rice price, right? Agricultural prices, the solution proposed by everybody are all demand-based solutions. Right? You want a cut in the consumption tax. You want a cut, you want an increase in income subsidies, right? That doesn't change the supply capacity of Japan. And the fact that Japan's agricultural policy has been a complete failure and that nobody in the political world has the guts to actually propose some changes that, by the way, Prime Minister Abe already proposed 15 years ago, which is that you should be allowed to consolidate small lot farms into bigger lot farms so that you can increase the yield and price elasticity, which, as you know, was vetoed and blocked by the locals, right, by the local agricultural lobbies. That is what is coming to haunt. So if there's one thing, I'm always very optimistic on Japan, but on Japan's agricultural policy, wow, it's very difficult to be optimistic.
Okay. We're running up against time, but very briefly then, so don't worry about the equity market, the bond market maybe. Do you want to just briefly say whether you think there are concerns over the bond market and possibly corrections coming up there?
Well, I think, again, a little bit, it depends a little bit on how you kind of describe and interpret these things. So we've been talking about Japan and inflation, etc., from a very macro point of view. As somebody who has kind of, been wringing my hands about the chronic deflation that went on in Japan for 25 years, I see this as a very good story for Japan, this reflation of the economy, the macro economy, getting back to a situation where nominal GDP growth is running above real GDP growth. The remarkable macro numbers in Japan, the GDP deflator, the overall measure of the price level and the rate of how it changes over time in Japan, is still 3% below its all-time peak, which was the second quarter of 1994. Now, how strange is that? Well, look at the change in the GDP deflator in the US in the same period, 95% up. So economists are taught, look at real, or we teach, look at real, not nominal variables. But it's nominal variables that people see and feel directly. And Japan's had this, 30 decades, up until the last 3 years, of nominal stagnation. It's breaking out of that. Now, what does that mean for interest rates? It means that the Bank of Japan should be able to, over the next few years, bring the policy rate up to something resembling a neutral normal rate. For Japan, that might be, anyone's guess, but it could be 2%. If you're more optimistic, even a little bit more, but let's say 2% territory, even a little bit more. That means with a term premium and some liquidity premium and, throw the premiums in. I don't think the solvency premium per se, but you get JGP yields up to, 3.5, even 4%. When I came into financial markets in Tokyo in 1995, JG bond yields were 4 to 4.5%. People nowadays think, that could never happen. Well, maybe it could happen. That means bond prices have to go down and interest rates go up. This will be perceived in Japan and written up by the reporters, every day, sorry, Anthony, as a bond market crash, solvency risks looming. But if Japan is to complete and anchor down this nominal re-anchoring of the economy, it will have to go through a process whereby ultimately bond prices go down and interest rates go up. And that will be, you can describe it as a very bad thing, but I would see it more as a necessary and positive thing as the economy normalizes. But again, the Japanese people are feeling it at the moment as a cost of living crisis.
Okay. Hung, a very quick final word from you maybe on bonds or not?
Yes, like I said in my original remarks, I look more at the bond markets, at the treasury markets, particularly as being used by the hedge fund in their business trade. And I think that is probably the source of new turmoil in the US market in the next period.
Okay, thank you. All right, well, we have actually run over time, although I hope some of you will have found the discussion as interesting as I have. Let me thank our panelists. It's our custom here to give 1-year honorary memberships to our speakers. I think, Jesper, you still have a current honorary membership, and Paul, you too, I believe. Hung, I'm not quite sure. I'll check the position, and if your honorary membership has expired, we'll make sure that a new one is sent to you. So please join me in thanking our panelists. And that ends the event. Thank you very much.